Okay, so what I'm going to cover here are dividend and dividend options. So a dividend is essentially a potential earnings on insurance policies. There are potential earnings on insurance policies. They're not guaranteed. So there are companies that are called participating companies, and typically it's companies that are mutual companies where they're not really owned by stock holders like on Wall Street. They're owned by the policyholders themselves. A lot of times the mutual companies are the ones that pay the largest dividends. Now, a dividend is a profit. So if we look at like the stock world, what happens is if a company declares a dividend, then a lot of times they'll pay that out to their stockholders. So the stockholders will essentially get like a small piece of passive income for having that stock. It's like sharing in the company profits. So life insurance policies have something very similar with dividends. This is potential earnings on your insurance policy. So what happens is with these companies, the insurance carrier actually charges a little extra for a premium on participating policies in case that company sustains a loss. Now, if the extra amount that is paid is not taken up by investment losses or excessive death benefit claims, then the policyholder can receive the unused portion back. Okay? It's not taxable, not guaranteed. So these are not guaranteed, and then the dividend is not taxable. Now, why is this? So, example, let's say that someone paid in $1,000 premium. They pay their policy once a year. It's $1,000. Okay, and it's an excess, it's an inflated premium. Now, say the carrier says, you know what, $100 of that premium was not used this year because we made more money than we wanted to. We didn't lose as much money as we thought we might, and we didn't pay as many claims as we thought we would. So what happens is the company says, we're going to give you $100 of that $1,000 back since $900 was all that was used for the premium this year, essentially. So it's received back as unused premium. That's why it's not taxed, and that's why it's not guaranteed. Because it's not guaranteed what their losses or profits will be, right? And it's not guaranteed, and essentially receiving some of that back, it's not like they're receiving any income. They're just getting some of the premiums they already paid in back. So, right? So it's like a refund. Like you're not taxed on a refund. So there are a few different ways that people can elect to use these dividends. So that $100 in that example. So for the example here, we have $1,000 premium. We're going to carry this throughout the rest of this lesson too. So $1,000 premium, only 900 used. That means $100 dividend in excess. Okay, so the person gets the $100 back. Now, there's a few things that this person can do with this $100. A few ways that they can get it or use it. One is cash, moolah, dinero, shmoney, cheddar, chicken. So whatever they want to call it. That's not, you don't have to know that, but bottom line, I'm making a joke there for a few mega serious people without a sense of humor. Company sends a check to the policyholder for that. So one thing, example here, if the premium was $1,000, but $100 is the dividend, then a $100 check is sent to the policy owner. We have Leah here. She also teaches the lesson with us, and she is actually the one who typed up this entire document. That's why there's mistakes on it, right? Cool. If the premium was $100, but $100 is unused, then a $100 check is sent to the policy owner. That's if they select the cash dividend option. Another one is a reduction of premium. It's pretty straightforward, exactly how it sounds. So remember how we said there's a $1,000 premium every year. Well, if one year they say, you know what, you have a $100 dividend from your last year, you can put that towards the next year's premium. So in that case, next year they'd only owe $900 if that's the case. So $1,000 paid before, $100 unused, takes $100 off the next premium, so $900 is the next premium if it takes the $1,000 after that, okay? Next, we have accumulation at interest. So accumulation at interest means that the insurance carrier actually keeps the dividend in an account where it grows. So the insured or the policy owner is saying, you know what, just keep my dividend, put it in a separate account, and let it grow in interest, and I'll be able to access it whenever I want. So the $100 goes into an account where it earns interest. Now the interest on the dividend is taxable, but not the dividend itself. Okay, so the interest is taxable, but not the actual dividend. So if that $100 earns $10 in interest, the $10 is subject to tax, and end up being maybe like $6, $7, or $8, depending on how much money the person actually made that they'd get from that. Because taxes are great. Paid up additions. So paid up additions is another dividend option. So paid up additions. So take two words here, the paid up part and the addition. So the paid up means that the dividend is used to purchase a single premium policy that adds to the face amount. So essentially, with life insurance policies, you can get a paid up policy. So they have single premium policies, they have 5 premium policies, 10 premium policies. Essentially, what it means is you're saying, take my $100 dividend and give me a permanent life insurance policy based on whatever that $100 will buy. So it's a fully paid up life insurance policy. They never have to make another premium on that policy. Now, that's the paid up part. Okay, so the dividend, the $100, is used to purchase a single premium policy that adds to the face amount. The $100 premium buys a single premium whole life, and it creates a small increase in the death benefit. So say they had a $50,000 whole life policy, and that $100 premium bought a $120 whole paid up face amount whole life policy, then that new $120 paid up policy would be added to the $50,000 original policy. So the death benefit would now be $50,120. Okay, that's the new face amount of that whole policy altogether. So it creates a small increase in the death benefit. All right, and that additional $100 policy accumulates cash value too and earns dividends. So now you have the big hunker junker policy earning dividends, and then you have the small one earning dividends and cash value as well. Okay, so they start working together, and it all starts to compound. And this is when you see life insurance policies really start to take off. And interest accumulation is when they use paid up additions. So if you see people who are like, oh, I want a whole life policy so I can earn a ton of money on my cash value, this is when they are talking about getting a policy through a participating company that earns dividends and using paid up additions, right? Because that $50,120 policy is now going to earn a larger dividend next year than just the $50,000 policy would. And then that new dividend is going to go to buy another paid up policy that's going to add on to it, and it just keeps stacking and compounding over time. So the graph is going to steadily increase over time. All right. So maybe if I can, sorry if I'm boring you guys here. Stay with me here. So say that we have a $50,000 policy, add $120 paid up, you get a $50,120 policy, new death benefit, right? And that earns a dividend next year too, and it keeps building. Okay, I'm also going to put this document in the description of the video if you want to access it as a study guide. So that just keeps growing and growing and growing. And this is the default option if no other dividend option is chosen. Next, there's the paid up option. So the paid up option, the dividends accumulated end up paying up the policy early, so no more premiums are needed. So essentially, that $100 keeps growing in interest and earning other dividends, and eventually goes to pay the policy up. So they say, okay, we're going to wait till there's enough money earned from the dividends and their interest to just pay the policy up, and then no one has to make any premium payments anymore. So that's the paid up option. Essentially, it's almost like a larger reduction of premium, where essentially there's just so much in there that no one has to make any payments anymore. Okay. And then next we have the 1-year term policy. This is the last dividend option, where dividends purchase a 1-year term policy that actually increases the death benefit. So it's either a 1-year term policy for whatever death benefit it can afford, or a term policy in the amount of cash value in the policy for as long as it will buy it for. So example, we have the $100 dividend, right? That may buy a $700 1-year term policy, for example. Okay, this is just an example. It's the actual amount of insurance it's going to buy is dependent on the age of the insured when they get that 1-year term. But this is just an example. Or it will buy term on say there's $1,000 in cash value, term on $1,000 cash value for 9 months or whatever it would buy it for. Okay, so those are the two ways that the 1-year term option can work. It can either say, okay, I got a $100 dividend here. How much term insurance will this buy for if it's a year term, right? And the amount that it will purchase depends on how old the client is when they get it. Or they're going to say, you know what, how much how long will this $100 dividend get me a 1-year term policy equal to the face amount of the cash, not the face amount, equal to the amount of cash value that's in there. Okay, so those are dividend and dividend options. I hope that helped you guys. I hope these explanations here helped. And if you need this document here, you can just check in the description of the video for it. As always, like the channel, subscribe, turn on post notifications. If you found some value in this, you can always work with me too. If you have any questions about what we do here at Senior Life Services, we hire agents nationwide to sell life insurance over the phone. We provide leads and everything else that you'll need to succeed. So if you want to do that, email me at jve@thejve.com. That's jve@thejve.com. Also, check out this video right here to learn about every single life insurance policy you're going to need to learn about for your life insurance exam course. Thank you.